Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. So it's 6:30 now. We're going to go ahead and get started. Excuse me. We're going to go for about an hour and a half. And tonight we're going to talk about investment fundamentals. So this is going to be very basic information, but I always think review is good. It's good to go back to the basics of why we do certain things. And tonight we're going to talk about why we invest and how we invest. I talk a lot about financial planning, and I think financial planning is really key to a successful retirement strategy. And but we can't dismiss investments. Investments are very, very important. I was explaining to someone today that there's been studies shown in financial planners, investment managers, folks like myself, we typically charge a percentage of a fee for what the assets, we call it, that a client has with us. And their studies been shown is that investment management, the value of that is really about 0.25% or one quarter of what the 1%. All the rest of the fee that you pay somebody, you have to look at is financial planning. So if you're not getting financial planning, if you're not getting tax efficient strategies for that fee, and it is standard that a 1% fee is standard. So if you're paying 1%, you should be asking what you're getting for the rest of that 0.75. But I've strayed a little bit with that. So investments are very, very important. They're certainly a part of a successful financial plan. So it's important to explore why we're investing, how we're investing, and we must start with the fundamentals. So before we get started, as we're having people come on board, let me just find my notes. Oh goodness! So I do want to remind you that everyone is muted. You have the ability for question and answer. Please ask questions as we go. If something pops up, just type in your question, and I'll answer it during a break. We won't take actual breaks during this because it's a relatively short webinar. We do breaks when we have our longer classes, but you don't have to wait till the end. Just type it in, and when I have an opportunity, I should say, I'll take a look at it, and then we'll address it then. And then if we answer it after you type it in, just say you've already answered, and that's fine too. There is a chat function, but chat is disabled. That's a regulatory requirement. And these webinars are recorded. And we have I shared this on my weekly webinars, we have just begun being successful in posting these webinars. So I'm going to share with you some of the things that you can find now. Where is my share screen? It's always fun with multiple screens, trying to track down where my little Zoom tool is. So let's put you folks up here. Okay. I'm getting there. So stay with me just a second, because now all of a sudden I've lost exactly what I was looking for. Okay. Well, I have a million things open for you folks because I have a lot to share, and now I can't find my actual own web page. So let me just open it again. So I'm going to attleborowealth.com. And I'm going to drop that down here, and then I'm going to share my screen. All right, so hopefully now you see attleboroughwealth.com. Please raise your hand if that's what you see. Wonderful. Thank you. And thanks for staying with me through that. My goodness. So we started posting these webinars, and you'll see under here in events, weekly events, special webinars, and live classes. So I haven't determined when we're going to start live classes again, but we'll do that at some point. But the special webinars, we've started to populate this. So this is the last one that we did a couple of weeks ago, and this is fiduciary planning for powers of attorney, trustees, and executors. This is the one prior to that. This is using annuities in Roth conversions and retirement planning. This is a webinar I did with David McKnight back in January. This is the well-received Medicare options with Steve Bobrin. This is another one with Brian Adler. And here's the man himself, Ed Slott, and me some time ago. I guess that was back in May. And then this is David McKnight doing his flagship Power Zero presentation. So that's always a great watch too. So we're starting to populate these. And then the next thing we're working on is you're going to see a similar page here in the weekly webinar. So I hear from folks often, I can't attend that Tuesday morning weekly webinar. Do you have recordings of it? So we definitely have the recordings. Now we're getting them out there on the web page. So you'd have to enter in your email to have access to the pages, but once you have that, you should be all set. So I hope that's helpful. Let me stop sharing. Okay. All right. So as I told you, this is the third in the recent special webinars we have. We're scheduled to have one once a month until we change that. Tonight is investment fundamentals. Next Wednesday, July 28th, is the reality of the 4% rule. So you've probably heard about the 4% rule. We're going to really dig into it next week. We're going to talk about how it was established and what it really means and does it really apply. But tonight, let's talk about investments. So such a broad category. My heating and air conditioning fellow was in the office today. The air conditioning stopped working. So I had to meet the HVAC guys or folks there today. And while he's setting up the new thermostat, he said, let me ask you, what do you think about cryptocurrencies and Bitcoins? And that seems to be top of mind with everybody right now. And we started talking about access and risks and all the things associated with any investment, but certainly cryptocurrencies and Bitcoin, things like that. But it's everyone's always thinking about investments, and it is a very, very important part of what we do for sure. But why in the world would you take your money and put it at risk? Well, the reason you would do that is because you want your money to grow for you. And then the question is, to what end, right? What is the purpose of that growth? Well, for most people, it is to achieve a certain goal. And that goal is, for most people, I want to make sure that I have enough money for me to live, me and my family, to live the lifestyle that we would like during retirement. I do mostly retirement planning for folks. Now, there's other goals, for younger individuals, but the crux of our practice is retirement planning for individuals and tax efficient and often tax-free retirement strategies. So we get into what's the purpose of those investments, and now what level of risk are you able or willing to take to see that type of growth? So that's the goals conversation. Now we need to talk about the tools conversation. And we get into, when we do our financial planning process, we have an 8-week process that we've developed over the years. And I think it works really, really well for several reasons. But people are often surprised that we don't even talk about what we're going to do with the funds that are now in our control until the third financial planning meetings. That's 6 weeks into the process at the earliest. Most financial planners and or investment managers, I'm told, and I've experienced, that's one of the first things they want to do. Well, let's get this going. You really have to establish those goals and really figure out what you're doing with those funds and what's the purpose of what you're going to what you want to achieve with those funds, and then how to properly place the funds to achieve those goals. The then we deliver all these ideas, and it can get very, very complex. So that's where I was hearing from folks, and I thought that it makes sense. Let's start at the beginning. Why do we invest? And what are the fundamentals? Stocks, bonds, cash, mutual funds, ETFs. So let's get into it. Why do we invest? Like I said, most people, they want to grow or they need to grow. Now, most people we work with, they're not looking at knocking the ball out of the park. They're looking at meeting their objectives, and they want to take really a measured amount of risk just to reach those objectives. And fundamentally, very fundamentally, there are three types of investments: stocks, bonds, and cash. And we're going to talk about all those. But let's first talk about risk. Now, you know Frank and Joanna Miller. Frank and Joanna Miller are example or sample clients of ours. We've worked through financial planning with Frank and Joanna Miller over a series of 3 or 4 webinars. We've shown their investments many, many times. So they're not real people, but they're a really good example for us. So we're gonna first look at risk, because all investments carry risk. So is there anyone out there with a show of hands? And I don't have a poll tonight, but I should have put one together for this. But is there any investment out there that doesn't carry any type of risk? Let me ask this. Raise your hand if you think that there are any investments that don't carry any type of risk. Okay, well, that's good. I've just said it, so I know you're paying attention. All investments carry risk, so even cash, and I'm going to show you a video on it from our website, but even cash carries risk, because while you put the money in your mattress or in the bank account, you may not lose anything. You have risk of inflation risk, right? So as things start to cost more, the value of that dollar is really valued less. And everybody's talking about inflation today. So let's look at the overall risk of different portfolios. So I'm going to share with you a tool that we use called Riskalyze. And I'm going to look at Frank and Joanna Miller. Now, I pulled this up a couple hours ago in preparation. It looks like we're still live on that. Oftentimes, when I'm pulling up websites and things like that in preparation for these webinars, I get signed out of things, but that's not the case here. So that's good. So let me share your screen, and I'm going to be sharing my screen a lot, as I usually do. And I'm going to be sharing different tools and resources. Some of them are specific to what we do and what we have access to. As you know, I like to also show you tools, and I do when I can, that anybody has access to. And I've got a lot of examples of that. So let me share the screen. Okay, so you should see something in front of you that says Frank and Joanna Miller, and it has a risk score of 40. Raise your hand for me if you see that, please. Okay, excellent. Thank you for everyone who's helping me with that. So this is a tool that we use called Riskalyze, and we look at investments, and we send a questionnaire to individuals, and it gives us a risk number. So it's a really, really great system, in my opinion. It's very psychologically based. It asks a series of questions about how you feel about certain returns, and it builds on one question after another, which I think is really, really smart. And it looks at, let me just share this with you. If you can see my cursor over here, it looks at a 95% historical probability over a 6-month period. Now, you may think that 6 months is not very long, but I'll tell you that is a really good look at someone's risk tolerance, because I think a year would be reasonable too, but 6 months hits it really, really well, because we've seen a lot of volatility in short periods of time. Now, the longest that we had in most recent history was the Great Recession from October 2007 until March 2009. There was a lot of volatility, mostly down, but we saw a great big drop this time last year. We started crawling out of it about this time last year, but from February, March until just about, I think it was the end of May, maybe June, when we started seeing a recovery from COVID. So this is an area where people start paying attention to their statements and they start seeing significant drops. So what we're showing here is that given their portfolio makeup, they have a risk number of 56. So that doesn't necessarily mean a lot to you, does it? But I'll tell you that using this tool, a 1 is zero risk, so that's the most conservative, and 99 is the most aggressive. So they're almost right in the middle, just a little to the right of center. And what I really like about that, it's kind of neat that they do it like a speed limit sign. That's great. That's kind of great marketing. It's something that we all understand. But I like that they use dollar amounts. It's not just, let me see if I can make this a little larger. That didn't work. They use dollar amounts. I hope you can see that. It's showing negative 11%, but also negative $144,000. Now, Frank and Joanna have $1.3 million. That's a very, very typical number, for folks going into retirement at their age. $144,000 negative over 6 months. So Frank and Joanna may look at this and say, oh my gosh, that doesn't work for me. I would feel really uncomfortable. Or they might say, I get it. I've been doing this a while. I know that that's the kind of the cost of doing business. Now, there are things that we can do to reduce that number and give them the types of returns that we want. You've heard me talk about this before. Asset allocation, principal protection, and account segmentation. If you go on my website under investment management, there's a video in there, 3 pillars of investing, that you should watch if you're interested in that. But today we're just talking about investments as a whole. Now, this is great. Here on this side, the green up 17.13%, positive 2.23. Anybody's going to take that, right? That's good. And we want to make sure that we're getting positive returns, but that's not a pain point for investors. Now, the only time that becomes a pain point is when they feel like they're not getting enough return on the positive side. And that happens too. And that's really also a key to account segmentation. But initially it's this. Most people roll into retirement and they say, I don't want to lose money. I can't afford to lose money. I'm 10 years older than I was, 12 years older than I was during the Great Recession. I don't have that ability to come back. So let's look at some of the individual investments here. And if you're a student, you notice something. When we looked at Frank and Joanna Miller's risk score, when they took the questionnaire, it came in as a 40, and their actual portfolio is at a 56. So that's different, obviously, and it's much riskier of a portfolio. 16 points is a lot. So it doesn't mean it's wrong. It just means it's a good discussion item to have, because again, they might say this is fine, or they might say, no, I don't like that. So here's a really good example of one of the major indices, and we're going to talk about it, what an index is in a moment. But this is an example of what Frank and Joanna Miller, or someone like them, may have in their investments, and this is a 401k. They might have the Dow Jones Industrial Average. Now, you've heard of this, and this is an ETF. We're going to talk about what an ETF is in a moment. But you'll see here that if we open this up, the risk of that is a 77, much, much higher than a 40. And it's got a significant amount of volatility. So best case is 24% over that same period of time. Worst case is 17%. It shows the annual dividend and the expense ratio. Expense ratio is the internal cost of the investment. Don't worry, we're going to talk about that. But that's just an example. That's one component, of course, of the portfolio. But risk is really important. So why are we using investments? We take risks to achieve a certain amount of return. And boy, it better be beneficial. Big concern right now is what's going to happen over the next X number of years as we're looking at potentially higher inflation. And many people are worried about a repeat of the 70s. I'm not sure if that's a legitimate concern, but let's keep our eyes and ears open about it. So before I pause, or before I move on from there, does everybody understand the kind of the idea of why we take risk and why we invest in funds, or invest our funds, whether it be stocks, bonds, or cash? And I want you to understand there's a risk in every part of that. Okay, very good. I don't see any hands raised, and I don't see any questions popping up. Very, very good. So let me stop that share. Let me move Frank and Joanna Miller out of the way. Just in case we got to come back to them, I'll stick them up here. Okay. So I showed you that Dow Jones Industrial Average, and that is some of the top companies in the U.S. in an index, and we'll talk about what an index is in a moment. But you might just say, well, listen, why not have all of our money in CDs, or why not just keep all of our money in the bank? And as I said, there's a risk of that too. So I found a video that I think might help talk about that. So I'm going to share that with you now. And this comes actually from an email that I just sent out, ironically, a day or two ago. And I have to also share my sound. So as soon as this starts playing, if you hear the video, I want you to raise your hand and tell me if you hear it or not. So let me go back. I'm going to go back to the beginning. I'm going to play this video for you. So I'm hoping you're seeing the video. If you're seeing it and hearing it, go ahead and raise your hand.
When we talk about inflation, we're not talking about filling a hot air balloon. Inflation is a rise in the general price level of goods and services, which erodes the purchasing power of a dollar. Though inflation has been under 5% for more than 20 years, it wasn't always that way. Many of us remember the high inflation rates of the 70s and early 80s. Even low inflation rates can pose a threat to investment returns. If your fixed income investments have a 3% annual rate of return, but inflation was 2% over that same period, your real rate of return was only 1%. The Federal Reserve's monetary policy-making team meets 8 times a year to monitor the economy, including the rate of inflation. Fed policy can have an effect on economic growth, and as a result, the rate of inflation. What is the real rate of return on your current investments? Don't let inflation take the air out of your investment portfolio. Call today and let's talk about it.
Okay, so that's a real basic look at inflation and the real rate of return. Now, the real rate of return can be negative. So what that means is that if you get a 2% rate of return on a CD or in your bank accounts aren't really offering 2 that I'm aware of right now, but and inflation is at 2.5%, well, you're actually -5. And then it actually gets a little worse than that, because most CDs and typical bank accounts, you have to pay tax on that interest every year. So then first you have to adjust for the tax, and then you have to adjust for inflation. So if you're lucky, you're just keeping it zero if you're lucky. But I got to tell you that CDs, money markets for sure, they tend to either just stay at zero or you're negative. So there is a risk with that as well. So it doesn't mean we shouldn't hold cash. It doesn't mean we shouldn't hold stock because it's too risky. It doesn't mean that we shouldn't hold bonds. What we really want is a mix of all of them. So how do most people buy these? Most people buy these in mutual funds. So what is a mutual fund? A mutual fund is really, I typically explain it like it's really just an empty plate. It's a vehicle that was established by Congress, by, these are laws that establish these. That's really pooled investments that allow investors to all pull their money together and invest in a certain way, and they have a money manager or a money management team who then takes that money and is deciding how to invest it. So there's different variations, and we're not going to talk about all the different variations tonight. Just remember that most mutual funds have active management. There's an investment management team or an investment manager who's making the decisions to what to own, what to buy, how long to own them, and really what the makeup is of that fund. So let me show you some examples. These are examples, not recommendations. So I want examples that are relatively easy to understand, that are available for you to look at, but in no way are these recommendations. So one of them, and again, I'm going to share my screen with you. Let me just see here. If you see me looking back and forth, I'm moving things from one screen to another. I think I've got 2 looks at this, and I do. So the first thing I'm going to show you is a research tool that I have. So this is something that you don't have access to, but then I'm going to show you how you really do have a lot of the same information. Once again, I'm going to share my screen. Okay, so you should see something in front of you. This is John Hancock International Growth. Just raise your hand if that's what you see. Okay, thank you, Ken. Ken's with me. I really appreciate that, Ken. Thank you. Thank you too, Carl. So this shows this John Hancock International Growth, and this is a fund that's run through a company called Wellington. You've probably heard of Wellington Asset Management, but they run that for John Hancock, and this is, I would say, a good fund. Again, not a recommendation, but you'll see here that this green line shows how the fund has performed, and the blue line, this is very simple. The blue line shows the benchmark, or what we compare it to. We always have to compare the performance of a fund to something that is non-actively managed. So the benchmark for the Wellington Fund, I believe, I should know that off the top of my head, but it's going to tell us here. Let's see. It's in other disclosures, but you'll see that other than a couple years here, a few years, the fund, I'm sorry, right here, the fund has outperformed the benchmark. So we're looking at relative returns. So it underperformed the benchmark in 2013 slightly, underperformed that benchmark in 2016 slightly, and again in 2019 slightly. But it really did well over different periods of time above the benchmark. And that's just one thing to look at. You also want to look at composition to make sure that it's what you it's invested in what you want it to be invested in. In this case, this fund is 100% international. Wherever you see equity, that means stock. So that's 100% international equity. You can see this expense ratio is 1%. It says net expense ratio is 0.99. So there's probably a very small give back on the fee there. And fees are really important. You got to decide if that's worth it. And one of the ways that you decide if those fees are worth it, as opposed to buying an ETF, and we're going to talk about that, and just owning the benchmark. Well, if you look at 2021 so far, the benchmark earned 6.81%. This fund earned 10.01%. These are gross. These are before fees. But so that difference is 3.20%. Let's just say for the half of the year, these should be as of June 30th, and they are. So you've got to ask yourself, is it worth it? That's for you to decide. But if we go back to, it shows you the top 10 holdings. So you can find it. Now, again, this is a tool I have, and I can go deeper into some statistics and other performance in here that help me. I don't think it's not necessarily necessary for an individual investor, and most clients just gloss over when I talk about these things. But you can also, let me drag this down. Now I'm going to go to Market Watch. Oh, Jiminy Crickets. Oh, it's right there. I'm going to bring down the same fund on Market Watch. Now, Market Watch, of course, is you know, it's a website that anybody can use. It's got a lot of great information, and you can look up a lot of the same statistics on these funds, and sometimes they're even a little bit easier to see. You have different growth numbers. You have standard deviations and measure of risk. I don't want to get into that too deeply. This fund status is closed, so that means that you can't buy it individually. We can actually still buy it, but most people cannot. Pay attention to these loads, front end loads. They don't apply in this fund, but if we looked at the same fund with an A share symbol, or a C or a B share symbol, there could be a load here. So you want to pay attention to that as well. And with these charts, you can really dig in here. So we can look at how it's done over the past 3 years, where its highs and lows have been. If you go into advanced charting, you can even lay over different things. I'm just waiting for this to populate. So you'll see you can do, let's compare it to the Dow Jones Industrial Average. And you can see how closely it matches and how it tracks along to that. Now that's not a great comparison because of the type of investing, but it's okay. You can just see how an investment in the Dow Jones Industrial Average might have done compared to this. So you can lay over as many as you'd like. And if we go all time here, we can get an adjustment on that chart. And we may not, it may be calculating there. Page is unresponsive. Okay, so we're going to get out of that. Okay, this is one of the issues with live, right? Okay, so that is a look at one mutual fund. Let me show you another one. This is a bond fund. So I'm going to share again. This is Market Watch. Once again. And this is Invesco Core Bond Fund. Again, not a recommendation. This is a fund that we use in our portfolios, but this is not a recommendation. These class shares are important to pay attention to. This is a Y class share, so this is an institutional fund, and it may have a minimum in here listed. It's only $1,000. Sometimes these are $2 million or so with these institutional funds. But you'll see that the year-to-date return on this is 0.71. Not really exciting, is it? But it's a bond fund, so bonds have been very volatile. Look at that drop-off from at the beginning of the year. So it was trading at $11.76 a share. You can see if you hover over that, and then it dropped down right in December to $11.43, and it's really struggled since then. But that has to do with interest rates, and we're going to talk about how things shift into bonds with the idea of more safety. But if you thought that you were safe in bond funds and they were all invested like this fund here and it dropped off of this cliff, how would you feel about that? That goes back to risk. So you've got to be aware of that. Bonds carry their own risk too. Does that make sense? I hope that makes sense to everybody. So you can find the same information here. I can't stress it enough. These are not recommendations. These are just examples. I'm going to stop my share there. I'm going to move this guy out of the way since we talked about that. And I'm going to move this one out of the way as well. So I've been talking a lot about index. So I use the index as a comparison. And I'm going to talk about an index as it relates to exchange traded funds, because these are what I just showed you are mutual funds. So remember, typically they're actively managed. They tend to have some cost involved. You saw, I actually didn't show you the cost of the bond fund, or I didn't discuss it. It was up there. Let me see if I can find it again. I think it was 0.5%. And it is exactly that. It is 0.5%. Remember, the other one was 0.99 or 0.98, depending on who was reporting. Market Watch had 0.98. The system I use had 0.99. That's pretty darn close. But the bond expenses are a little less. That's typical because bonds tend to be held longer in funds than stocks. They have less of a turnover. Although this one has a 329% turnover ratio. That's an actively traded bond portfolio for sure. Excuse me. But I'm comparing them to indices or an index. And in a moment, I'm going to talk about ETFs. ETFs, or exchange traded funds, are huge, and they just keep getting more popular and more popular. I use ETFs a lot. I think there's a lot of value in them. I think there also carries a lot of risk to it because part of the volatility that we're seeing in today's markets are a heavy use of ETFs. People can trade in and out of the markets intraday. A lot of the volatility that we see is what we call black box trading, where money management firms will say, if this happens, then do this, and if this happens, then do this. And then when we get dramatic drops in the markets, they start selling off, and it just exacerbates things. So what is an index, first of all, before we talk about ETFs? An index, one of the ones that we hear all the time, and I showed you, is the Dow Jones Industrial Average. So the Dow Jones Industrial Average is 30 companies chosen for stability and of growth and earnings. This index was established in 1896 by Charles Dow and Edward Jones, and it just had 12 companies. This has changed 51 times since 1928, so this index does change. The Dow components are chosen by S&P, Dow Jones Indices, and there are no specific rules for the inclusion. So generally speaking, components of the Dow should be large and respected companies. However, they aren't the 30 largest companies in the market, which is a common misconception. And the Dow Jones Industrial Average is price weighted. So, there's more components that are I'll say the more expensive ones are heavier in the index. Now, how about the other one we hear all the time, which is the S&P 500 index? Well, let me read to you the description of the S&P 500 index. The S&P 500, or Standard & Poor's 500 index, is a market capitalization weighted index of the 500 largest U.S. publicly traded companies. So why do we see a difference in the S&P 500 and the Dow Jones Industrial Average? Today's a really bad example because the Dow was up 0.82 and the S&P 500 was up 0.82. But if I look historically so far this year, let me just pull that up quickly for you. I'll share this with you too. This is one of my favorite. I'll download it real quick and then I'll share it with you. This is one of my favorite resources, and this comes from Invesco. And just as an aside, now you folks that are on my Tuesday weekly webinars, you hear or see this all the time. But this is one of the markets reviews that I get each week. Ironically, this one's from July 9th, so it's a week back. I think the fellow who sends it to me is on vacation this week. But here's the indices I'm talking about, or the indexes. The Dow Jones Industrial Average, that's the one we just talked about. Remember the 30 companies. Let's shift it. What happened there? I don't know why that's all blue. There we go. So that's up for the week 0.25%. Now let's look at the S&P 500. You would think that they're about the same. Now we know that one is price weighted, one's capitalization weighted. One represents 30 companies, one represents 500 companies. Now you'll see here that for that 1 week, the Dow Jones Industrial Average was up 0.25%. The S&P 500 was up 0.42%. And look at the difference so far this year, 15.05 compared to 17.23. And there's about, not quite a 2% difference, 1 year number. So 1 year number means this time last year to this time this year, and actually July 9th last year to July 9th this year. And you can really, there's a lot of information obviously in this chart, but this yield curve is really important. We're going to talk a bit about bond risk, but we're looking at bond prices here, or interest rates, excuse me. And you'll see the 10-year Treasury, where it closed in July 9th, 2021, and where it closed the week before. I'm right here. I don't know if you can see that in my cursor, but look where it was last year. So year end 12/30, 2020 was 0.91, but this time last year, that 10-year Treasury was at 0.61. I've never seen it that low in the 20-some years I've been doing this. And thankfully, it's coming back up to where it should be. We still have a long way to go with that. But I just wanted to show you the difference there between the return of the Dow Jones Industrial Average and the S&P 500. This does not in any way mean that you should invest your money in the S&P 500 because it's got a higher return. Things are going to flip-flop for sure from time to time. No doubt about that. Someone asked me about a Callan chart a few weeks ago on one of these calls, and the Callan chart is it just spreads out and shows you how different. Let me see if I can pull one up while we're talking about it. So it shows you how different investments return over different periods of time. Calendar chart. So just stand by here. And I just, yeah. All right, I'm striking out with that one. I will talk about that perhaps on one of my webinars. Here's one. So once again, I'm going to share my screen. And this is an example of a calendar chart. We're getting a little bit away from the fundamentals here, but not really. But this is kind of small. Let's see if I can make it a little larger. So what you'll see is this goes back from 2001, I'm at the top here, to 2020. And it shows you the top performing category in every year. So I want you to take a look at that for a second. So in 2001, the best was U.S. fixed income. So when you hear fixed income, think about bonds. That's what that is, really. Now the next year it was global fixed income. The year after that, it was emerging markets equity. So these are smaller, not necessarily smaller countries, but smaller economies outside of the U.S. Typically outside of the U.S. And well, it's always going to be outside the U.S. because we're a big established economy. Then real estate, then emerging market equity again, then real estate. That flip-flop pretty interestingly for a while. Fixed income. Now small cap, small company stock, back to fixed income, back to real estate, back to small company stock, back to real estate. And then in 2015, it was large company stock, then small company, emerging markets again, and cash in 2018. Look at that. That's a surprise. So the moral of the story is you never really know what's going to perform well. So that's why you want representation in all different areas, and you want to keep your account balanced. But you can look at these Callan charts, CALLAN, and you saw that I just Googled it. It took me about, 20 seconds to find that. Really what you don't want to do, and the purpose of this is you don't want to look back to what worked last year. So we don't want to look at small companies and say, well, geez, that really outperformed last year. I'm going to shift all my money into small companies. Look how well they did. My buddy, my neighbor, my cousin did so well, and I didn't. So I'm going to shift into what he or she did just last year. Well, you see, you're almost inevitably set up to fail. Was there ever a period of time when it was the same back to back? I'm not seeing it. And if you see it, you can raise your hand. But what often happens is this, exactly. Look at 2017. Emerging markets were hot. And you say, oh, geez, my buddy said he did 37% last year. I should jump into that. And in 2018, they're at the bottom of the list. That is very, very usual. Cash was the next there. You can see it. Whereas real estate drops down, was a negative return here. It was positive 15% here. It was negative here. So that is small companies are 2010 top of the tree here, negative 4% here. So don't do that. Don't just put all your eggs there thinking that, geez, that worked really well last year. And certainly you can't, if you can pick a pattern out here, I want you to email me immediately and let's have a discussion about what your process is and see how we can capitalize on it. And I'm being a wise guy because you just can't, there's no pattern to be had there. Excuse me. Okay. So that's the Cowan chart. So that's, we're going to come back to asset allocation in a moment, but the Cowan chart is really fundamentally explains why we use asset allocation. I'm glad we talked about that. Okay, so now you know what an index is, and back to the S&P 500. This 500 largest U.S. publicly traded companies by capitalization rating. The index is widely regarded as the best gauge of large company size U.S. equity. So even if you only invest in the S&P 500, you're only investing in the large size companies, and you're missing a lot, aren't you? If you look at that Cowan chart. There is a woman out there who gives a lot of advice on TV and the radio. She was a Merrill Lynch financial advisor a long time ago. Her name's Susie Orman. I think Susie is a great educator. She used to always talk. I haven't listened to her in years, but she used to always talk about all you need to do is invest in the S&P 500 index fund, low costs, and all those things are true. But you'll see that if you just invest in the S&P 500, you potentially miss out on a lot. And in fact, many of you may know that there was what we call the lost decade. So from 2000 to 2010, the S&P 500 returned 0%. Zero's not just as bad as negative, but it's painful and can greatly affect a retirement, just like a negative return can. Where if you were allocated among all the different areas of that Cowan chart, you would have most likely have received some type of positive return over that time. And there's a really good chance that you would have been very positive. So the S&P 500 again is capitalization weighted, and those components are weighted according to the total market value of their outstanding shares. Shares outstanding refer to a company's stock currently held by all its shareholders, including share blocks held by institutional investors. And institutional investors would be someone like BlackRock or Invesco or a large institution that invests in these things. And restricted shares owned by the company's officers and insiders. A company's number of shares outstanding is not static and may fluctuate widely over time. So now that's mutual funds. And we have stock mutual funds, we have bond mutual funds, we have real estate investment trust mutual funds. There are thousands and thousands of mutual funds, and you can invest in gold, you can invest in silver, you can invest in, like I said, real estate. These are highly regulated entities. They have to they have filings they have to file every year. There are some issues with them though. You can't trade them intraday. This is what some people don't like about mutual funds. You can't trade them intraday. So if I have a fund that I need to sell out today, or I want to be more active in it, you really can't trade that until the end of the day. So you put the order in. If it's 9:30 in the morning, students, the market opens, it's not going to get placed till the end of the day. So you don't know what the price is. You have no control over what we call capital gains. There's a lot of buying and selling that goes on in mutual funds, and you can have a down year and still owe capital gains tax. And that upsets everybody all the time, for sure. So you have no control over how they're traded. You also really don't have transparency. You really don't know what they own until they do their quarterly filings. And most people don't read those, and they don't even read the annual reports. So you can look at on Market Watch or where I showed you, it shows the top 10 holdings. But beyond that, you're not getting much information. Most people don't understand who's running the funds and what their philosophy is, and they should. That's what we look at. But they're transparent. I don't want to say they're not transparent. They've become much better. They list their expense ratios, because it used to be, very, very difficult to determine how much a mutual fund costs. But that's gotten much better. But that's one. And then what I showed you as an example are two funds that have really earned their keep, where they charge 1% in the case of the John Hancock Fund and 0.5% in the case of the Invesco, and they've done well over that fee that they earn. But there are many mutual funds out there, and the majority of the mutual funds out there, in fact, about 92% of the mutual funds that are out there don't meet or exceed their index that we compare them to, like the S&P 500 or the Dow Jones Industrial Average or whatever works best for that fund. And we're paying them, we being the masses, or I should say they are charging a fee to underperform. And that doesn't sit well with most people. So a long time ago, ETFs, when I first started in the business, were just starting. So that's 2001. People started looking at different alternatives, and they came up with these ETFs. And the idea behind the ETF, an exchange traded fund, is that you can trade intraday. It trades just like a stock on an exchange. And if you want to sell out of your S&P 500 fund, you can do it at 9:30. You can do it at 10:30. You can do it at 3:55. Anytime there's trading, the floor is open. You can trade. it's fairly transparent because you know what's in the index. It basically builds a basket of stocks that match an index. There is a lot more control over the tax efficiency because mutual funds have to buy and sell positions to either, if you get people who need redemptions, so they want to sell their shares of mutual funds, they keep a good amount of cash on hand just for those situations. But what if somebody who has a large position in that mutual fund needs to sell out of it? Well, then they have to sell their stock positions or their bond positions or whatever positions they have, and send the clients, their customers, their money. Where or rebalancing, when they're making adjustments in their portfolio, they generate lots of trading in there, and that causes that tax. Where ETFs can do an exchange, they can say, okay, we're making changes in the portfolio. We can exchange for another basket of stocks, so it defers that capital gains, which people find beneficial. They're also much lower cost. So some of them have creeped up in cost as they become more active. ETFs are typically passive. They just track and exchange. And that can be a positive or a negative. I believe, and this is my philosophy, there are areas where active management makes sense, and there are areas where they don't make sense. And in my position, or my opinion, when we're talking about large companies, particularly large U.S. companies, you're probably better off with an exchange-traded fund. There's not a lot of value out there in mutual funds or active management, whether they be, you hear these actively managed portfolios or separately managed accounts where they hold individual stocks. And, there's a group on TV, Fisher Investments, that talks about that. And they're a separately managed account manager. And they'll compare themselves to the S&P 500, but most people who do what they do, they don't beat the S&P 500 and often take more risk than the S&P 500 and charge more. So if you can own the S&P 500 for, I'll give you an example in a moment, for well under, I know a typical Fisher investment portfolio is 1.25%, and 1.25% to track the market. You determine yourself if that's worth it or not. But here's an example. I'll share my screen with you. So here is a Vanguard exchange traded fund that I like to use. And what I was saying before was, I find that large companies, there isn't really a reason to have active management. Where you find value is in bonds, fixed income right now, and international companies and emerging markets and things like that, where certain moves of investment management can really make a difference. So here's a Vanguard S&P 500 ETF. Raise your hand for me if you see Market Watch Vanguard S&P 500 ETF. Thank you. And you'll see this is the trading throughout the day. I think this is one day. Yeah. So this is volatility throughout the day. Again, this is just so sophisticated these days, what you can do compared to how it was when I started in the business. Nobody really had this, but this goes back to the beginning of the year, obviously. But here's the Vanguard S&P 500 ETF. Now, let's look at the cost of owning the Vanguard S&P 500 ETF. 0.03%. So compare that with a large company money manager that's 1.25 or 1%. That's significantly different. Now you have to buy it. There are trading costs. But I would ask, are there really trading costs anymore? Any portfolio we have, we don't charge trading costs. We charge a fee for management of portfolio and financial planning. I talked about that before. But companies like Charles Schwab, I don't think they charge any trading anymore. They make their money. A company like Charles Schwab makes their money, believe it or not, on the difference between your cash holdings. So what you have in cash, what they're paying you in interest, and what they're making on that money. So their idea is to bring in as much money as possible. People are always going to hold cash, and that's where they make their money. So they're able to minimize or completely eliminate those trading costs, which we're seeing. Very, very small turnover. One of the mutual funds I showed you was 392%. This is 4. Turnover means how often they're traded, because ETFs just don't trade internally. This is a really good example, actually, of the difference between tax risk in an actively managed fund and passive trading. Now, the problem here is that you're going to get 100% of the highs and 100% of the lows of the ETFs, of the S&P 500, excuse me. Now, that assumes that it's tracking well. What does that mean? Now, there was a study done many years ago, I should say several years ago now, that showed, I forget how many S&P 500 exchange-traded funds, but let's say 20. And there was a 5% difference between the lowest and the highest exchange-traded fund. That means that the S&P 500 was zero, right? Not zero return, but that was where they started. And some traded or had returns 5% higher, and some had 5% lower. That's what we call tracking error. So we want to make sure that this is tracking very, very closely to the index. So let's actually see if we can easily add that. And we'll take a look at how closely Vanguard is tracking. Oh, they've changed this a bit, or I was on this site messing around. There used to be a way just to add an index, and I don't see. No. Well, I'll bring that. We'll work on that for the next time. But let me go back to the regular. Okay, so that is the S&P 500, and that's a really good example because, again, a typical large company manager will be somewhere between, the low end 0.5%, on the high end 1%. It is it's very difficult for managers to charge over that 1% these days because everybody's sensitive to fees, and they should be. But you see Vanguard comes in at 0.03%. But there's definitely pros and cons. The ETFs have some cons. We know they're tax efficient. We know they're liquid. Mutual funds are also liquid, but you have to wait till the end of the day. They're flexible. You can invest in different things. It's not just the S&P 500. Geez, you can probably invest in there's a Bitcoin ETF right now. Diversification, yes, you can diversify portfolio using exchange traded funds. You can also do that in mutual funds. There is more transparency. Access is about the same. But you don't have that active management. And as I explained, there are times that that's beneficial, and there's times that they aren't, or that isn't. I talked about how ETFs are created. There's a basket of securities, and they exchange cash for ETF shares. And the securities represent the underlying index. And it's a process of creation and redemption that, if we were having a test on this, that would kind of be the buzzwords, creation and redemption, when we're talking about exchange traded funds. We talked about the in-kind exchanges that you can do, and that gives you some flexibility of when you pay the tax. So basically, in most cases, you pay the tax when you liquidate the ETF position that you own, and you aren't caught up in much, if any, of those internal capital gains. There are some actively managed ETFs, though, that cannot do in-kind transfers. And these actively managed ETFs are becoming more popular. Now, there are also exchange-traded notes. They're more complex. There are leveraged ETFs. We're not going to talk about those. This is just a really basic look at investments, as I said, and ETFs is one of them. The trades can become limited. One of the concerns is liquidity risks you often hear. I think that was pretty well covered last year with the big COVID drop, and tested well. There are a lot of sales in ETFs. None of them stopped trading that I am aware of. That was a concern that I've heard people say, because there always has to be mutual fund. Even if the price of the securities go down, they can sell and they can get their money out of there. With ETFs, there has to be a buyer on the other side of that transaction. There was no no halts as far as I know. So liquidity risk, I'm not sure how viable that is. Of course, you're always going to have portfolio risk. So if you own the S&P 500, there's no stopping it, right? If you go down, now you can trade options on an ETF, and you can't do that on mutual funds, and that's interesting too. And I talked about that tracking error. You want to make sure that your ETF that you want to own is tracking that index the way you want it to. Now, ETFs, they and mutual funds, but you see it mostly with ETFs these days. These target date funds have become very, very popular. So Fidelity calls them freedom funds. We're going to look at that in a moment. But a target date fund is when you just say, I want to retire in 2051, so 30 years from now. And it starts with a more aggressive portfolio and automatically adjusts to a more conservative portfolio. So I'm going to use Fidelity as an example because Fidelity is the largest provider of 401ks, and that's where most of these sit. And I see this all the time. People come to me and they say, I have a target date fund. It's usually not established correctly, and most of them don't do well. T. Rowe Price, again, not a recommendation. I'm just sharing some experience. T. Rowe Price does a nice job with target date funds, but still, there's a lot of risk that sits in here. So just raise your hand for me if you can see this Fidelity, a lifetime investment approach in a single strategy. Ken, you are on it. I really appreciate that. He beats everybody. He's like quick draw. So I see other hands come up, but Ken is just bang. Very good. So you'll see this is kind of a difficult chart. It took me a minute to really see, but the green here is the dark green is domestic equity. So what does that mean? Domestic, U.S., right? U.S., see the flag behind me? The U.S. and equity is stock. International is everything but the U.S. and stock and bonds. We all see now they go equity, but they don't go fixed income. Bonds, you can also hear fixed income. And then short term, well, that could be cash. That could be really short-term bonds. But you'll see here at 25 years old, you have mostly U.S., a little bit of bonds, 10% of bonds, and 36% here of international. Now, some people might say, well, why even have bonds at all? Well, there are times you saw in the count charts that bonds outperform stock, and why wouldn't we have some representation in there? When we put portfolios together, we use historical returns and we use math, and we move the portfolio around until we optimize it. That's the best way to do it. And then you do it all the time, and you make changes as you need to make changes. These target date funds are just set to go on their own. Now, I showed you that the bonds and bond ETFs, especially, this is where ETFs can be very dangerous. Bond values are down, right? So far this year. I think I showed you that in the Invesco. That's where I think active management can make a difference. And what happens here is as people get closer to retirement, look at this, 37% of their investment, 60 years, is in bonds. That may be appropriate. It may not be appropriate. You might think that bonds are safe, but as I showed you earlier, bonds are very risky right now as interest rates go up, if they ever go up again, or as interest rates are unstable, as we know they are, there's a lot of risk in bonds. So you might be carrying a tremendous amount of risk and you may not be aware of it. This might be an area where active management might work for you. It used to be that I would say, when I was constructing a portfolio, I'd say, we are going to buy individual bonds instead of using a fund or a money manager so we can at least own the bonds. That's very, very difficult to do today because of the availability and how quickly they are snapped up by institutional traders. And at 70, this shows 50% in bonds. So the point being, it kind of ratchets it and changes it as you get older. And first, you got to choose the right one that's for you, and then you got to make sure that it's still weighted correctly. I was on the phone with a woman today who's 84 years old, I think, and she's got most of her money in stock, and she says, people tell me I should be diversifying this. And my answer is it all depends. I mean, one of my most aggressive investors who passed away a couple of years ago, he was 96 years old. He hated being in bonds. We gifted away all the stocks in his portfolios and estate planning strategy. And his bonds started coming due. And because we had individual bonds. That's how I used to construct portfolios. And we built up stock again to where he was all 100% stock, and he didn't need the money. Thankfully, he was very fortunate, but he liked being a stock investor, and it worked well for him. There was, he could lose quite a bit and it wouldn't have affected him. It's really for the next generation. He did fantastic with it, but it doesn't, just because you're 75 years old or you're 70 years old or you're 25 years old, there's no thumbnail, rule of thumb, excuse me, that says exactly how you should be invested. It depends on what your needs are, what your risk tolerance is. The risk tolerance is all about just keeping you in the game, keeping you invested. It's really not any more than that. It's psychology. It's where can you take it to where it's going to make you pull it out. I used to say you're going to throw a brick through the window, because the way you win at the game of investing is to make sure you've got the best components in your investments and to stay in the game. Everybody knows that, but knowing it and acting on it are two different things. So these target date funds, while good in practice, can be very, very dangerous in my opinion. They often get kind of like set it and forget it. And that's kind of how they're sold, set it and forget it. I think that's terrible. Fidelity, listen, I got nothing against Fidelity. I use Fidelity as my custodian. Fidelity loves a set it and forget it approach because you're going to have the funds in there for the next 30 years and they collect their fees all along. Don't think for a minute that there aren't any fees in these accounts. They're not going to show you on this chart what the fees are, but if you went into them, and sometimes these target date funds are sometimes hard to get information about, but you're certainly going to pay fees, and they're typically higher than creating the allocation yourself. All right, no questions on that. So there's target date funds. So let me close this guy up. Okay. So what about so we talked about mutual funds. We talked about exchange traded funds. We talked about target date funds. What about individual stocks? Why not own individual stocks? Why not put together 30, 40, 60 positions, 500 if you wanted to, try to match the S&P 500? Why not do that? Well, you have ownership in the company with an individual stock. You have potential dividends. You're going to get growth, potential growth, potential loss. Here's why that's a challenge for most people, including people who do what I do. Most people don't have the time, education, or resources, or sometimes all three, to put together the portfolio and manage it on a regular basis. And I would say that anybody who does what I do that says to you, we are going to put together an individual portfolio comprised of somewhere between 30 to 40 individual stocks, and we're going to manage that portfolio specifically for you, is not being honest with you. Because they cannot be an expert in all the different, remember that Callan chart, all the different categories of investments: real estate, cash, bonds, international, emerging market international, U.S. equities, large company, small company, mid-sized company, and then go deeper into that, technology, pharmaceuticals, because you have all that. So why would you even want them picking your individual stocks like that? Because they're also meeting with clients. They're also, doing webinars. They're also doing financial planning. Hopefully they're doing all these other things. I want the people managing portfolios to be glued to a screen. Their glasses are this thick because they're always looking at a screen. And they're an expert lasered in one category. And most of those people, 92% of them, don't do the job right or don't get the performance right. Most of those people who are staring at the screen all the time, 92% of them underachieve the index that we're compared to. So anybody who's telling you they're going to put a portfolio together that's specific to you is not being honest with you and not being honest with themselves. They may believe it, but they're not being honest with themselves because they can't be an expert in all those categories. And I will take that challenge if anybody wants to challenge me on that any day. So that takes us back to mutual funds, ETFs, and the like. That is why they're so popular. There are things you can do with individual stocks, tax loss harvesting. You can do that with mutual funds. You can do that with ETFs. You can be very, very specific with individual stocks for sure. Some people have done very, very well with individual. I've had great luck with individual stocks. Been very, very fortunate. But I've also been very, very fortunate, and I've had clients been very, very fortunate with mutual funds, ETFs, and other investments. Individual bonds. Let's talk about individual bonds. So individual bonds, as I told you, I used to use that really extensively in building out portfolios. They're just so hard to buy today. You know, I sit, if you've been following me for a while, you know, I sit on the board of directors at Council Rock School District. We issue bonds. They're tax-free municipal bonds. So they're kind of tax-free municipal bonds. They're federal and local and potentially state tax-free. But the interest will cause your Social Security to be taxed potentially. But they're snatched up so quickly. Individuals just can't buy them, and there's just very, very few out there. I have bought some for clients. They're often so marked up that it's not worth it. So most of the time we're using exchange traded funds or bond funds. A bond is simply a debt. It's a debt to the municipality, a school district. So let's talk about what is a bond. So Council Rock issues a bond. We did about $140 million worth of bond issuance in the past 12 to 18 months, or is scheduled. I guess we're still in the raising phase. So that is debt to Council Rock. We're taking your money and we're using it. In the case of Council Rock, we're using it to build schools and renovate buildings. For that, we pay you interest. It's a dividend, right? Or not really a dividend. They're coupons or interest. So for that, you earn interest. It's either taxable or potentially tax-free. And then at the end, with municipal bonds, as long as the school district is still in operation or the organization is still in operation, you get your original investment back. Most bonds are bought in $1,000 increments. Now you can pay more for that $1,000 bond, and that's called a premium, or you can pay less for that $1,000 bond, and that's called a discount. When I'm saying that most of the Council Rock bonds are marked up, for $1,000 issue bonds, you may pay a $1,100, $1,300, something like that, because the credit rating is so good. The tax authority is strong, so people are willing to pay up for that bond. Whereas if it was a City of Philadelphia bond, for example, you might be able to buy that at a discount because you're taking more risk. So maybe $1,000 issue bond you might be able to buy for $900. So you end up getting more over time for that. But the idea is you receive that interest payment over a number of years. Some bonds are issued for very short periods of time, 3 years, 5 years, 10 years. Some of them are 30 years. So you either longer period of time or a shorter period of time. Typically, the longer period of time that your money's tied up, you get more interest. That doesn't always happen. That's where you get this inverted yield curve or flat yield curve you hear sometimes. That's a more complex conversation. But just know that when you're talking about bonds, that is debt of an organization. It can be government. It can be corporate. Right? You can buy corporate bonds. They tend to give a little higher yield. Yes, a higher yield than municipal bonds because they don't have they have more risk and they don't have the more effective tax treatment. That's corporate bonds. And then government bonds, U.S. government bonds, are considered the safest bonds. And you'll see, I shared with you the Invesco report, and I can show it. This is a good time to share it again. Let me just grab it. Here we go, looking all over the place. And this shows the U.S. government bonds. This is a really good time to have this conversation. All right, so here's our Invesco. Ken, give me a hand raise if you can see this. Okay, thank you, Ken. So here's where we are, right in the middle. Remember this? Right in the middle of this screen, right here. Here we go, the crazy blue again. Let's hold it. So here's your 6-month U.S. Treasury. That's what that means. So at the close of business, July 9th, 2021, that was yielding 0.05%. That is very super safe money, right? You're only tying your money up for 6 months in the U.S. Treasury. It's likely, certainly likely, that the U.S. government isn't going to default. So you only get 0.05%. The question is it even worth it? That's up to you. If you tie up your money for 2 years, well, you're earning 0.21%. And if you tie it up for 10 years, it's 1.36. So that's the U.S. Treasury. And that's considered the safest. And you'll see 2, 10. Now it also goes 30. 30 was taken off the table for a little while, but then it was brought back in. But let's look at how the performance of some of these indexes have done so far. Look at this is an aggregate. So this is the Barclays aggregate. Now I'm over here on the left. See where it says fixed income. Remember, that means bonds. The aggregate bond so far year to date is down 1.18%. Remember that safe investment? You're down 1.18%. That is what many bond funds compare themselves to. So this is the concern about that ratcheting in that target date fund going more to bonds, because you're down 1.18%. Now, inflation, everybody's worried about inflation right now, and rightfully so, because inflation is high right now compared to what we've seen over the past decade or more. And it looks like it's going to continue to go higher for some time. So we get the Bureau of Labor Statistics report on a regular basis. And the last one I saw in the past week, it was 0.99% or 0.9% over month. That's 1% just in 1 month. You extrapolate that over a year, that's 12%. That's crazy. We can't afford that. 5% is too much. 3% is really difficult as well, because most people have been banking on lower interest. So let's use 3% as an example. I said interest, I meant to say inflation. If inflation is at 3% and your bonds lose you 1.18%, what's your real rate of return? Remember that video in the beginning? Well, that's right, negative 4.18%. If your 2-year treasury is yielding you 0.21% and the inflation is at 3, what's your real rate of return? About negative 2.8%, 2.79%. So that's what you're talking about. And that's why you need exposure to equities, to stock, to help balance that out and help give you some growth. And that's where the risk comes in, the higher amount of risk. But there is risk in every one of these investments. So I hope that makes sense, and I hope that's helpful. Be very, very cautious of this. Well, I want to put it more into bonds because it's safer. We're seeing this right now, 1.18. These are the non-U.S. bonds loosely. This is down 5%. High yield munis here. So these are higher. High yield is financial services term for junk bonds. That's up almost 7%. So you see different areas. There are positives in the bond market, but this is the most widely used, and it's down slightly. And even the short term is up very, very little, 0.05. So that's still a negative return given the cost of inflation. I hope that's not too complex for you, and I hope that was helpful. So I'm actually gonna keep Barclays open, or this investment review at a glance open, in case you have to come back to it. So now that you understand some of the fundamentals of the instruments, and now that you've decided what you're going to use, mutual funds, ETFs, individual stocks, bonds, cash, again, just the fundamentals, then you've got to think about portfolio construction. So in the time that we have left, we have about 10 minutes left, I'm going to go to my whiteboard, and I'm going to talk about portfolio construction. Let me pull this guy up. I was signed out of this. Let me just sign in and create another one. All right. So portfolio construction. I'm going to share my screen. You're going to see me looking down because I move this down so I can write, but hopefully you can still hear me. I got a new microphone. I shared with you that I have my two sons. One's just went back to San Diego yesterday, but they're helping me get these videos up and do some other things in my 19-year-old son has been doing a great job with video editing for me finally. And we have more than 100 videos over the past year and a half. So it's a tremendous amount of work for him. But he convinced me to buy a different microphone and stop being so cheap, Dad. And so I'm hoping you're hearing me loud and clear, and maybe clearer than what you did in the past. But I thank him for that. All right, so I'm going to share my whiteboard with you. All right, so let's talk about portfolio construction. Now, remember, I'm probably not going to go into the 3 pillars of investing. You can find that on my website under investment management. That's I think worth looking at. But now that you've chosen, I'm going to use individual stocks. I'm going to use individual bonds and cash. Again, just fundamental. Of course, there's so much else out there. There's deviations or different types of mutual funds. There's different types of investments. There's hedge funds. There's all kinds of stuff. But stocks, bonds, and cash. It's for fundamentals. Now that you've decided what you're going to use, stocks, bonds, and cash, or mutual funds, or ETFs, or a combination. Maybe you're going to do a combination of them. Now you've got to figure out how you're going to construct your portfolio. Well, what most people do is they use some kind of risk analysis tool and they come up with their pie chart. Okay, this is what I need to do. Let's go back to Frank and Joanna Miller. Frank and Joanna Miller came in at a 40. So if we were to rank that on a scale 1 to 10, well, let's use their scale, 1 to 100. Obviously, 50 is in the middle. 40 would be right about here, right? So I would call that, if this being the most conservative, and this being the most aggressive. Now, remember when we looked at the Dow Jones Industrial Average at the S&P 500? That came in at a 77. So to reach a 100, you really have to be like foot on the accelerator. And this would be moderate. So 50 is right in the middle, moderate. So let's call this conservative growth. I've got all kinds of red flags going on in my head with this, because we just may not be able to fulfill our needs if we're 100% invested in conservative growth portfolio. But let's just assume that we're staying with this, and that's at a 40, and we're going to do a conservative growth portfolio. So to use typical, this is not my approach. I want to caveat that. You all know my approach: asset allocation, principal protection, account segmentation. There's the 3 pillars of investing. And again, let me just, if we have time, I'll share that with you where that is. But the typical investment says this would be a 60-40 portfolio, and this would be 60% bonds. I hope you're thinking, oh my gosh, it's got some risk, and 40% equity or stock. And it doesn't matter if it's mutual funds, ETFs, or fixed income, because they're all going to fall in these categories, as you just learned. And you fill these in, as you need to fill them in, right? So you've got bonds, you got stock, you got all these different components. And if we did, it's going to look kind of like that, right? If this is bonds, and if this is, I got it the other way around. So if this is stock, and if this is bonds, it's going to look kind of like that. Now you've got to ask yourself this question: what's my philosophy? 2 general philosophies: tactical investing or strategic. A big discussion going on right now is thematic again. I would argue that thematic is tactical in nature. Thematic is, I believe that infrastructure is going to be a big play because of the money coming out of Washington or not coming out of Washington, and I'm going to overweight companies into transportation. I think that electronic vehicles are going to be a big thing, so that's a theme. So the theme is going to be infrastructure increase, electric vehicles, service stations, service areas for electric vehicles. Those are themes. So that is division, I would say, or type of tactical investing. Tactical investing is you believe because of some research, thought, triggers, what have you. Some people just do charting and it's tactical. Like I believe because the S&P 500 ETF reached this certain level, we think it's going to sell off, so we're going to sell it, and that's just based on different charting. There's head and shoulder. They say, okay, this is a new resistance level, and when we hit that, we're gonna sell. In my opinion, that works for some people. I've never seen that work on a measurable and something we can replicate and something we can count on. Looking 20 years from now, with tactical investing work better than strategic investing? I don't know, but I feel like strategic asset allocation and investing is something we can work on. So tactical is really underweighting or overweighting based on some type, I know it's very general, but they're all different, some type of information. So whether it's charting, whether it's thematics, whether it's some other kind of piece of information, you're underweighting and overweighting and underweighting positions. Some people say, I want to put money in gold, I want to put money in so here's a really good example. Last summer, BlackRock came out. BlackRock's a really well-respected firm. They review my portfolios and give input on the portfolios. They're a great partner that way. They said that they believe that the European Union was going to do a better job coming out of COVID than the U.S. So they're overweighting the European Union, underweighting the U.S., and it was the exact opposite. U.S. crushed it coming out of COVID. The European Union didn't. So that was a really bad call in the case of BlackRock. Could have worked out the other way, though. But that's a good example of tactical investing or tactical asset allocation. So what is strategic? So strategic asset allocation simply says for a given amount of risk, you get a certain amount of return. I'm going to just switch these because it's usually how it is. Return for you get a certain amount of return for a given amount of risk. So not to get too technical, but you have this capital market assumption line and you have portfolios along this line. So if your risk goes 1, 2, 3, 4, 5, 6, 7. Let's just go to 7 in this example. Where this is just going to be really simple. Obviously, you can get returns higher than 7. You get returns, lower than 1. But for a certain amount of risk, you get a certain amount of return. So as long as your portfolio components are good and you can measure the amount of risk you're taking, and to get really technical, that's measured as standard deviation. As long as these components stay strong and they stay rebalanced, you've heard that term. I'm really fighting myself not to get into the asset allocation and principal protection and account segmentation strategy. That for a certain amount of return or a certain amount of risk, you're going to get a certain amount of return. So that's been mathematically proven. This is modern portfolio theory. Modern portfolio theory was a Nobel Prize winning theory that I believe was done in the late 50s or early 60s. That's escaping me right now, so it's not terribly modern, but it is well proven in my opinion. And I like the fact that you can mathematically prove, by back testing historical returns and get a strong assumed rate of return. Now it's investing, so we don't know for sure what's going to happen, but that is strategic asset allocation. So once you determine what tools you're going to use, then you determine how you're going to implement it. Now I'm going to need to stop there. That is 7:58. I would love to now talk about asset allocation, principal protection, and account segmentation, because I think that makes all the difference in the world now that you know the fundamentals. But you can go onto my website, and I'm just so happy these tools are up here now because I can just refer to them. So I'm going to share with you where to grab this if you want to continue this discussion on your own. And I'll share my screen with you one more time. Oh, I guess you're seeing it already. So you see my website already, right? So Ken, raise your hand if you can see my website, if you're still with us. Thank you, Ken. Ken, I feel like I owe you a six-pack or something for all the help today. All right, so if you go to events and you go, no, I'm sorry, that's not where it is. If you go to investment and segmentation, investment management segmentation, and you scroll down here, you're going to see a video, 3 pillars of investing, and you can click on that, and that'll carry the story further than where we just left it. So I'd love to get your feedback on that video. You can watch it at your leisure. This video here tonight will probably be up in a couple of weeks. Our next webinar is next Wednesday, and we're going to talk about the 4% rule and what that really means. You folks have been great. I appreciate all the interaction and all the help. As you log off, you're going to have access to my calendar. I do have some time. My calendar is very full, but I have some time if you want a consultation. Other than that, I'll see you on Tuesday and maybe next Wednesday. And if you have any questions, if you have any comments, send me an email. I'd love to hear from you. Thanks, everybody. Have a great night. Take care.
Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.